So you want to fix your credit score? Fast? Not in 5 years. Not eventually. You mean now. And you're tired of the same recycled advice like, just pay your bills on time. Yeah, no kidding. But here's the good news. There are actually real, strategic moves you can make right now that will boost your score in weeks, not years. Let's break down exactly what a credit score is, how it's calculated, what really moves the needle, and how to flip the script on your finances this month. What even is a credit score? Think of your credit score like your adult GPA, but for money. It tells lenders how risky you are to lend to, and it follows you everywhere. Loans, credit cards, renting an apartment, sometimes even job applications. Your score is a 3-digit number between 300 and 850. The higher, the better. Here's the breakdown. 800 plus equals excellent. You're the bank's favorite child. 740 to 799? Very good. They'll offer you cookies and low interest rates. 670 to 739. Good, you're fine, but not special. 580 to 669 then mas, fair. They'll squint a little and charge you more. Below 580, your danger zone. Hello, 29% APR. The modern credit score, known as the FICO score, was introduced in 1989 to help lenders make objective decisions. Before that, it was basically the Wild West. Credit decisions were often based on who you knew, where you lived, or even racial and gender biases. True story. Today's system isn't perfect, but it is hackable once you know how it works. Credit score factors and how to hack them. Your FICO score is made up of 5 categories. Here's what they are, how much weight they carry, and how to improve each. Number 1, payment history, 35%. This is your track record. Do you pay your bills on time? One missed payment can tank your score by up to 100 points and stay on your report for 7 years. Here's your fix. Set up auto pay today, not tomorrow. Today. If you've missed payments, get current ASAP and stay current. Call your lender and ask for a goodwill adjustment. Sometimes they'll remove a late payment if you've been reliable. Number 2, credit utilization, 30%. This is how much of your available credit you're using. Say you've got a card with a $2,000 limit and you've spent $1,600 and that's 80% utilization. Yikes, that alone can drop your score like a rock. Keep this below 30%, ideally below 10%. Quick wins. Pay off your card multiple times a month. Ask for a credit limit increase, but don't spend it. Open a new card if you're not applying for a big loan soon. Fun fact, most credit card companies report your balance at the statement date, not the due date. Paying early can make a big difference in your reported utilization. Number 3, length of credit history, 15%. The longer your accounts have been open, the better. This is why closing old accounts can backfire. Keep old cards open, even if you don't use them. Just make a small purchase every few months and pay it off. Also, consider becoming an authorized user on a parent's or partner's long-standing, low-utilization card. You don't even have to use the card, just being on the account can help. Number 4, credit mix, 10%. Lenders want to see you can handle different types of credit, not just plastic. A healthy mix might include credit cards, revolving credit, auto loans, student loans, installment loans, mortgage or personal loan. You don't need every type, but if you only have credit cards, consider a small credit builder loan or something like Self or Chime Credit Builder. Number 5, new credit inquiries, 10%. Every time you apply for credit, it dings your score a bit. Too many applications in a short time? Red flag to lenders. Only apply when necessary, and shop around for things like auto loans or mortgages within a 30-day window. They'll count as one inquiry. Fast fixes that actually work. Want to move your score within 30 to 60 days? Try these. Pay down balances below 30% utilization. Request a credit line increase. Dispute errors on your credit report. 1 in 5 reports has them. Become an authorized user on someone else's card. Use tools like Experian Boost to get credit for utilities and rent. Historical context. Before the FICO score, lenders had almost complete discretion. In the 1970s, the Equal Credit Opportunity Act had to be passed to prevent discrimination. The FICO model was meant to standardize decisions using data instead of gut feelings. But the system still favors people who know how to game it. That's why we're here. Real-life examples. Let's look at a case study. Meet Jordan. Credit score, 585. They had 3 maxed-out cards and 1 late payment last year. They thought they were doomed. Here's what Jordan did. 1. Called their credit card issuer and got a $1,000 increase in credit limit. Boom, utilization down. 2. Used tax refund to pay 1 card down to 20%. 3. Became an authorized user on a parent's low balance card. 4. Used Experian Boost to report their rent and cell phone bills. 2 months later, score jumped to 670. Not perfect, but a massive improvement. And it opened up better loan offers for a used car. Common myths debunked. Myth number 1, checking your own credit hurts your score. False. That's a soft inquiry. You can check your own report all day. Myth number 2, you need to carry a balance to build credit. Nope. Pay it in full. Carrying a balance means paying interest. Building credit means using it, not owing it. Myth number 3, paying off a collection resets the damage. Not exactly. It updates the status but doesn't erase the history. Still, a paid collection looks better than an unpaid one. And some scoring models ignore paid collections entirely. Where to check your credit report? For free. You're entitled to 1 free credit report every year from each bureau, Experian, Equifax, and TransUnion. Go to annualcreditreport.com, https://www.annualcreditreport.com. Not sketchy, actually legit. Look for incorrect late payments, accounts that aren't yours, duplicate listings, old collections that should have dropped off. Disputing these can give you quick wins and a cleaner report. Why this matters. A higher credit score doesn't just mean bragging rights, it saves you real money. Take a 30-year mortgage for $250,000. With a 760 credit score, you might get a 6.5% rate, equals approximately $475,000 total paid. With a 620 score, that might jump to 8%, equals approximately $660,000 total. That's a $185,000 difference. Same house, same loan, just a different credit score. The bottom line, fixing your credit score fast is possible, but you need to work smarter, not harder. Focus on what actually matters. Lower your utilization, pay on time, build positive history, dispute the errors, ignore the myths. Financial freedom isn't just about making money, it's also about not losing it to bad credit. Wrap up. Your credit score is like a passport to the financial world. With a good one, you can travel through life with ease. Low interest rates, better apartments, easier approval on loans. The key, consistency, strategy, and knowing how the system works. It's not about being rich, it's about being smart. You can fix your score. You just need a plan. Now you've got one. Smash that like, subscribe for more, and comment below with your biggest credit win or horror story. This is Cash Me If You Can, teaching you how to game the system without going broke trying.